This is TreppWire Week in Review for the week ending August 11th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, economic data suggested the Fed might actually pull off a soft landing. The July jobs number released last Friday came in lighter than expected, which suggested the U.S. economy was not on full boil. And Thursday's CPI numbers were in line with expectations. Normally, this would result in resounding approval from investors. Yet this week, we saw stocks labor. Manus, what was behind the market's muted reaction?
Well, there's several theories you could put out there. I think that after 7 months of blistering performance for equities, the markets were probably due for a timeout. I think we saw just, if not record-breaking performance in the first 7 months, close to it in terms of the rally for the S&P 500 and the NASDAQ. So that we're in a bit of a lull right now, I guess, is not a terrible shock. It's probably even less of a shock when you consider that interest rates remain persistently high, and that I think that while people believe what you said at the open, that a soft landing or no landing is likely, I still think that they look at the economy and say, lending remains constrained, prices remain uncomfortably high, and what will be the next engine for hyper growth? We saw a lot of enthusiasm in May and June for AI, and that really drove a lot of the gains that we saw. But now it looks like a bit of a tired market. Perhaps some of that is due to the fact that traders and money managers are at the beach or the mountains this month. We have sparse trading. People are away in August. But we're certainly in the dog days of August. There's no denying that.
Yeah, I would agree, Manus. I think a lot of this could be attributed to everything you outlined, and maybe even more related to the August being the month of holiday or vacation. And it seems like just across the spectrum, we see a lot less activity during the month of August. So I think that definitely plays a role. I had some macro news to go through. We talked last week about the ADP jobs report. We have U.S. payroll growth that was reported this week, 187,000, which was lower than expected. Some interesting tidbits there. Unemployment rate was 3.5%, which was against a consensus estimate that would hold steady around 3.6%. So right in line. Average hourly earnings rose for the month, 0.4%, which puts us on pace for about a 4.4% annual growth, which are both above expectations. And then CPI, has been a leading discussion point for us here on the podcast, but less so over the last couple of months. Rose 3.2% in July from 12 months earlier. That was reported today. Annual rate for inflation was below expectations. Good news there, and especially if you look at the lagging indicator of the shelter cost, which factors in the rent, you could make a case that it's even less. I think the one thing I've seen around people discussing this is that oil prices that have kind of been consistently rising over the last couple of months might pose a threat to the Fed hitting the 2% target. And I know if you look at just gas prices over the last 6 or 8 weeks, you start to see a pretty significant uptick there. And then lastly, on the macro side, and kind of get your thoughts on this, Manus, there's been a lot of discussion around this balance between inflation coming down, interest rates going up, and consumers taking on a lot more debt. And so there were some publications this week that were saying that for the first time in history, credit card balances jumped over $1 trillion. And, to give some perspective on that, total credit card, debt increased about $45 billion from April to June, which was more than 4%. I think I saw another stat this week that said the average credit card balance for a family was like over $7,000, and the average savings is $5,000. So it just kind of begs the question, as the soft landing gets more and more strength and people thinking we're maybe going to hit that, is that really going to happen when you have student loans that are about to come back and payments are going to start happening, and you have consumers that have piled on a ton of debt over the last 18 to 24 months?
I think you bring up a lot of really good points. I think that soft landing or no landing doesn't mean that we're taking off, right? The two are not synonymous. We may not see a recession but that may not mean that we see extraordinary growth. And maybe that's what's getting into the heads of investors right now. There's no mistaking the fact that by historical measures, stocks are expensive right now. Their PE ratios are near historic highs, and that makes people nervous. I think that will certainly make money managers cautious. We saw a lot of negative headlines this week. You touched on some of them. Consumer debt topping $1 trillion for the first time. We know that student loan debt is starting to kick in again. We also know that debt is now being serviced at a much higher rate, the consumer debt level. Today, the 10-year Treasury, not that that's what drives consumer debt. The consumer debt is off of shorter term interest rates, but 10-year was today at 4.10, which is near its highest point in the last 2 years. I think it got up to about 4.40 at one point, but it also got as low as 3.40 at one point in the spring. The 1 year is well above 5% now, 5.5%. The 2 year, I think, is close to 5%, if I'm not mistaken. Let me pull it up, 4.82 as of the close today. And at some point, that's got to leave, some kind of scars on the marketplace, I would think, right? That at some point, that combination with a higher debt that people are carrying and the student loan debt that you're talking about has to slow down the economy. And then one other highlight that we saw, or low light, I guess it would be, a headline that we saw from Bloomberg this week was that banks remain constrained. Haley was mentioning this before we came on the air, that Bloomberg had the headline that banks are not only not lending, but they're looking to shed debt wherever they can, especially for commercial real estate debt. And that is not a recipe for strong growth. We've seen people like Barry Sternlicht out there talk about a dearth of lenders right now. We've seen it on Twitter too, people saying where they used to get 30 bids, now they're getting 2 bids on their new projects and stuff like that. And so all combined, I think that if you're a money manager, you're looking at all this and you're looking at both sides of the scale. On the one hand, the odds of getting like a 4% GDP number in the next year or two versus, a no landing becoming, like a 1 GDP and a bumpy economy in 2024. And you're saying, maybe it's time to, raise a little cash and not be as aggressive as I was earlier this year.
Yeah, the bank stuff is interesting because I think we kind of brushed it under the rug. We've had a few failures and everything's kind of calmed down, that there's not a recipe out there for more banks to fail. And I think the challenge is some of the same underlying conditions are still prevalent. And so if they can divest of some of these things that have higher exposure to default or delinquency, I think they would be well suited to do that and looking to make those moves. And to your point, we've posted a bunch of issuance information over the last couple of months. I mean, if you just look at new origination volume, down significantly by any measure across the different asset classes year over year. One other tidbit that I thought interesting this week, coming from someone that lives in Texas, so I don't understand how this math works, but for people that live in Manhattan, they hit a new record high of $5,588 a month for rent. So when you compare this to the pre-pandemic levels, that's 30% higher on average than what 2019 rents were. And so about 9% increase over last year's. And the median rent, maybe a better measure is at $4,400 a month, which is still a new record with average price per square foot of about $85. That's according to a report from Miller Samuel and Douglas Elliman. It's 4th time in 5 months that Manhattan rents have set a new record. So I think you guys get a bunch of roommates up there, or there's something that's required to live in the city, because I don't know how people are making that work, $5,500 a month just for rent.
It is a staggering number, I have to say. And I can't believe we haven't seen stories about, people splitting shifts. One guy who's a teacher rooming with another guy who's a night watchman, right? So they could take turns sleeping in the apartment. It is a staggering number. It just keeps going up. It's really mind-boggling to me. As a really frugal person, I'd be buying one of those tiny houses that you see marketed here and there, where I have a 400 square feet, put it on somebody's lawn somewhere and pay them a couple $100 in rent every month and make the best of it. 5,100, good God.
So last week we talked about the July delinquency readings. We talked about the headline number and also the increasing rate for office. But this week we broke it down a little further and actually looked at the balance of the loans and what types of loans are going delinquent.
So yes, this was a great report. It was done by Jack LaForge. Before I get into that report, I just got to remark on one of our emails we usually wait for the end of this, but we did have an email from one gent who gave Lonnie high marks for his bearishness and his belief that delinquencies were going to go above 10%. And then he went 3 times further and he thought delinquencies will get up or distress will hit 30%. And all I could say is I'm not with this gentleman. I respect all opinions and I appreciate the reach out. It was a nice email and thank you for that. But if I were to believe that, I wouldn't be on the podcast right now. I would be buying survival kits for my basement. I'd be buying that 3-year supply of rice and freeze-dried meat and iodine for my basement. I'm just not there, but I do know that some people are very bearish on the market. The piece that Jack did this week was very interesting. We've heard rumblings before that some analysts, people that write research for CRE, had been talking about small balance loans outperforming big balance loans more recently, that people who had debt under 50 million or under 20 million were muddling through. They were finding ways to find new partners, white knights, cash from their own personal holdings to fund cash in refinancings or somehow pay off their existing debt or keep it current. We wanted to test that thesis, and Jack went out and did the heavy lifting for this. And what we found was that historically, large loans have really lapped small loans in terms of delinquency rates, meaning the delinquency rates on SASB loans and loans north of 50 million historically have been a percentage point or 2 lower than what you see on the smaller loans. We've seen 3 exceptions to this. One was during the great financial crisis when those numbers flipped modestly, when the big loans became more distressed than the small loans. It happened again during COVID for a short period of time. And now it's happened again this month for the first time. And so the thesis that Jack put out there, which I really thought was a good one, was that for money managers who have to put money to work, who have to spend assets and buy assets, because that's what their charter is, a good place to hide might be CMBS deals where the balances are small, right? CMBS deals can be made up of loans anywhere from about 2 million up to 300 million within a conduit package. Some deals are very heavily loaded with the top 5 or 10 loans. Some are much more diversely spread out across smaller balance loans. And if Jack's thesis is correct, this might not be a bad place to hide for the next couple of years if you're looking for outperformance on the distress side.
Yeah, I think it's an interesting story, and Jack did a great job of kind of putting the data to work. It's interesting, both times prior to this where we've seen that inversion has been in times of economic hardship, and we're definitely seeing some of that now. So it'll be interesting to see how this plays out. I know we've kind of tossed the term of, recession out instead of recession. And it seems like in this case, the first to feel the impact of delinquency has been these really prominent high dollar value buildings, and the smaller mom and pop type locations are still performing and not having the challenges. So we saw a lot of this during COVID too, where you would see, strip retail centers where the mom and pop tenants were still coming in to work and, paying their mortgage, and the folks that were national credit tenants were demanding 40 or 50% rent reductions and threatening to not pay. And so in this environment, sometimes having the smaller balance, smaller owner operator type mentality actually works to the benefit.
Well, there is strip mall guy out there who's prolific on Twitter. I know, Lonnie, you follow his stuff. I know several of my buddies that are really on CRE in Twitter follow him. I've seen him before and I do read his stuff whenever I stumble across it. And, one of his theses, using that word a lot today so far, has been, the guys that run nail salons, barbershops, small businesses like that, they're always in demand, they're always open, and they're always generating business. And they are the kind of tenants that keep you going. And, maybe there's something to that. While some of these bigger guys starting in COVID and now continuing post-COVID continue to pare their footprints and be more strategic, the guy that cuts your hair for $10 or $12 every week just keeps showing up for 30 years, paying his rent. And, and that keeps these smaller properties alive and vibrant and going. And I like the idea. I do like the idea that in the next couple of years, smaller balance, things will find a way to muddle through more so than the Johnny-come-latelys that have put together big syndications and have grown really fast, or people that took on big projects, $100 million debt and up over the last couple of years in big 24-hour cities. We'll see.
Yeah, I think you see the delta between trying to make a living and trying to make a promote, right? Or generate a return. And in this case, the make a living is winning during these times of economic turmoil.
So let's start with office this week. I don't think we can jump into the headlines without starting on WeWork.
Yes, the WeWork story seems to come around and rear its ugly head about every 2 years or so. It first started with more positive than negative. People were excited. WeWork was coming in, renting up space hand over fist. There were people exercising caution or warning about the growth. Sam Zell was one of them back in the day. Wendy Pei of Ellington was another. I remember her at a conference talking about her concern about how much space WeWork was taking up and finding its way into CMBS deals. We all know about the $47 billion value that SoftBank had put on it 4 or 5 years ago, the going public, the retrenchment, the giving back of space. Really, for the last 3 years, it hasn't been a happy story. A lot of lease terminations, a lot of situations where they just flat out stopped paying rent. The stock was trading under $1. And this week they announced yesterday on Wednesday that there was substantial concern that they were going to continue as a viable company. And there wasn't much room for the stock to fall. It was already trading at 60 cents and it went down to 40 cents. But it did send a lot of our listeners and our readers and our customers scurrying around to remember exactly where all that CMBS debt was. And it's substantial. Dozens and dozens of CMBS loans have WeWork exposure. A lot of those loans have balances of $100 million or up. The WeWork space is not cheap. It's in very high profile locations and buildings. And this will probably lead to more distress. The big one, of course, we've been following for a long time on California Street. It was not only a building that they were tenant in, it was a building that they also invested in and purchased. That's probably the biggest of them all, but there's several others for which WeWork will now leave a big hole. I think the term they used yesterday, I heard it on a radio report as I was driving yesterday. They've seen tenants giving back space hand over fist and not renewing and just relinquishing whatever space they had there. And they saw no end in sight for this. So not a pretty story.
Yeah, I think the WeWork stuff is kind of like the American Dream Mall. You can make a bunch of bad jokes about the name and them not working out. But, to your point, Manus, there's a broad swath of exposure here. We put out a tweet this morning that highlights some of the exposure, about 112 loans, current aggregate balance of over $9.5 billion of WeWork exposure. And to your point, a lot of these are really nice office buildings in great locations with really high rents in place with WeWork. So it'll be interesting to see how this plays out, but it doesn't look like it's good news. It kind of has the Bed Bath & Beyond vibe from a few months ago.
I'm not sure if I should bring this up, and I wasn't planning to, but since you brought up the Dream Mall, I thought I would take a quick pivot. New York and other cities are facing a crisis right now. This was another headline we saw. New York, Boston, other cities dealing with a migrant influx. In New York, they said it's 100,000 people coming in. Mayor Adams says there's no space. It's actually kind of a good story for hotels because they've commandeered a lot of hotels. They've taken a lot of inventory off the market for hotels that are still open for consumers. There's a lot less competition now, but that's not why I brought this story. They have been putting migrants in tents on Randall's Island, which is between the Bronx and Manhattan. But I thought to myself, as I was driving down the turnpike yesterday, why not use that Dream Mall for this purposes? The tenants that are in there see no foot traffic. They'd probably love to be bought out of their leases. This thing has bathrooms, air conditioning, right? You're not having people sitting in the 90-degree heat in space where there's no trees. Commandeer to that, right? That seems like the place to take over. JP Morgan will probably love you for this because I think they're the owners of this following the foreclosure.
Yeah, I was going to say that's an interesting take, but probably not too outlandish. I mean, the reality is that may be a better highest and best use for that space compared to what it is right now. And so, Mayor Adams has come out saying they're trying to figure out a plan. And sometimes when something like this happens, at least at this scale, unconventional solutions actually provide the best option.
I do find it a little discouraging. And by the way, Haley, just prepare yourself for, perhaps some hate mail coming in from East Rutherford, New Jersey. I'm not really sure about that. That's right where the Dream Mall is, off the Jersey Turnpike. But one of the discouraging things that I heard from Mayor Adams, and I don't know what to make of this, and I try not to beat up our politicians too much, but we're a city of 8 million people, really 20 million when you consider the suburbs, but in New York City proper, 8 million. We've seen 100,000 people added. So fractionally, what you're talking about is 1 or 2% uptick in people. And I understand that that's a wave, but he said that our expenses have gone up 5 or 10 or 15% because of this. And it makes you wonder, how can we not be prepared for something which is no more than the number of people that you see coming to Yankee Stadium and Citi Field for a day game in July? There's something about it which I think we got to be better than this somehow. We got to be able to handle situations like this without either losing our minds or completely losing our fiscal, the fiscal wheels coming off. It's disturbing.
Yeah, you just don't know how much of that is political posturing or how much of that is factually true. But I'm with you. I mean, just on a pure numbers play, this should not disrupt anything to the level in which they're saying that it does. And to your point too, like that's what government and officials like that are supposed to be prepared for, situations that arise that require leadership. So I'm hopeful they'll figure something out. There's a human component to this as well. It's not just fiscal cost and, additional burden. So hopefully for everyone involved, they can figure out an alternative solution that, provides some humane living conditions or resting conditions or whatever without significant economic impact on the negative side.
Amen to that.
So let's break down the office stories from the week.
All right. I have these kind of littered in an email that I wrote to myself. Here goes. Let me start in Lonnie's neck of the woods. We saw a couple of stories in Texas this week in the sublease category. The first one comes from The Real Deal. Indeed is looking to put 185,000 square feet of space out for sublease in Austin. The firm splits its headquarters between Austin and Stamford, Connecticut. In Austin, there are 2,900 Esperanza Crossing. The property doesn't back any CMBS debt, but the new 200,000 square feet will push sublease space availability in Austin now above 6 million square feet. So that's something to watch. Also in Texas, this comes from The Real Deal's Joe Lavenger. Jack Henry is looking to put about 100,000 square feet of space on Central Expressway in Allen out for either sublease or for purchase. Jack Henry is asking for $23.50 a square foot. The property itself, appraisers say it would go for about $134 a foot if it were sold. Lonnie, this is not something we see all that often. A lot of sublease space coming up in Texas, a couple stories both in 1 week.
Yeah, especially in those markets. Austin has been was the darling coming out of the pandemic in terms of office space, but that tech scene has dried up a little bit. And so you're starting to see some of the sublease availability. The Indeed property is interesting. I think that building traded probably 6 years ago and at a really premium price because it had a long-term lease in place with Indeed there. So them putting sublease space out, not a great sign for that individual building or for that market as you highlighted. And then Allen is another market that's just seen significant growth and been, kind of on fire over the last couple of years. So it's interesting to see that we're starting maybe to see a few cracks in even these stronger markets. But on a relative basis, they're still, I would assume outperforming a lot of the other office markets that we've talked about over the last several months.
Next topic I'll turn to. We've talked endlessly this year about the reversal of fortune for landlords as it pertains to the big tech takers of space, the big 5 to 7 firms that were just gobbling up space in huge bites over the last 10 years. So that would be Facebook, Google, Microsoft, et cetera, Netflix, and others, just taking square footage in 100, 200, 400, 700,000 square foot bites year after year, city after city. We've talked about that flow changing, that so many firms have reverse course and have either let leases lapse, as Microsoft has done in Seattle, or have pulled the plug on specific projects like Microsoft did in Atlanta and Amazon has done in Virginia and in Portland. But this next story talks about how this may not be over. The first one talks about Meta. Meta, in the report I was looking at, claims to have spent $1 billion in lease terminations and other real estate pullbacks over the last year, which is an enormous sum. But they came out and said they may spend an equal amount of that going forward, $2 billion to reduce their footprint. You know, that is just a staggering amount of lease termination fees and buyouts that they're facing right now. And it does speak to the challenges landlords are facing in those markets where tech has been huge. The other story was from SF Gate, San Francisco Gate. This comes from Stephen Council. Google was expected to shell out $500 million in lease termination fees this year. They've already topped $600 million. In fact, it's $633 million in lease termination fees thus far. So they're running more than 20% ahead of where they thought they'd be at this point during the year. So both firms really taking sharp pullbacks, and that's not a great thing for the Class A markets.
Yeah, and that's in addition to, you know, what they're spending on payroll cuts and other things relative to their real estate portfolio. So yeah, not great news. I remember you and I, man, is kind of scratching our heads when we started going through our deals of the week or whatever for about 4 months there, where it was every week, multiple 100,000 square foot leases signed. And we were saying, what do they know that we don't? And I think it's proven that they didn't really know anything that we didn't, and that they made some decisions that they're having to walk back now to the tune of some really big dollar amounts. So, you know, if you're a landlord and they terminate and you get to recapture a lot of that on a termination in an upfront fashion or over some sort of amortized period, you know, that's not completely negative for you today in the sense that you're getting to realize some of that cash. But to your point of, you know, what does this mean for the office market going forward? We've talked exclusively that there's been a bifurcation in the office market between the Class A's and then everything else. And it, you know, you just wonder on some of these Class A stuff, if like this continues, are we going to start seeing some additional delinquency and erosion even in the Class A market that up to this point we've been able to avoid, you know, compared to some of the lower class office properties.
Right. The bad news out of this story, of course, the landlords are the bad news, no doubt about it. They will get these termination fees, which can be very substantial. The other bad news is offices are part of an ecosystem. And if these offices close down, chances are that they're impacting the deli and the restaurants in the area and so forth. And that may make the office less attractive for other tenants as well. So that's the downside. The upside is these landlords can, with the help of these termination fees, offer perhaps more competitive rents and come in maybe $10 a square foot below what other landlords are offering and attract some new tenants in very quickly. And let's hope that that's the case. We don't want to see that 30% default rate that we referred to earlier in the podcast. But I got to pivot for 1 second, Lonnie. You talk about you and I scratching our heads. I got to say that's my general 24/7, you know, posture. I got to say, my kids will say, well, I walk around scratching my head all day long. That's it. Like I walk around like a confused boomer, and there's no avoiding that. And that's my go-to look. So, you know, it's not just on the 45-minute pod every Thursday that you get that look from me.
Yeah, I think I have a similar look. I have really crazy eating habits. I'm obsessed with commercial real estate. I don't really have any other activities outside of work or real estate or teaching. Although I do drag race old muscle cars, and actually got to go out this last Sunday and do a little drag racing for the first time in 2 years. So maybe I'll post some videos on Twitter or something. Me and my dad spent some good time together and enjoy doing that. Unfortunately, we haven't been able to do it as much as I'd like. It was 110 degrees though, so it wasn't like super awesome. Yeah.
You'll have to post those videos, Lonnie. I gotta get a look at this.
Yeah, race car driver Lonnie. In fact, looking for sponsors. If anyone wants to sponsor a fledgling race car activity.
Do you have the overalls, like the jumper? Is that what you wear?
Yeah, I got a full on fire suit, helmet. It's a 5-point seatbelt harness, roll cage. Like, it's the real deal, man. It's 0 to 100 in less than 7 seconds. Pretty intense stuff. 446 cubic inches of big block Mopar American muscle. Pretty intense stuff.
The image I'm getting, and this is going full boomer on everybody, is that Keanu Reeves in Parenthood. If you've seen the movie Parenthood, which was a great movie with Steve Martin and Rick Moranis, it was kind of a Jason Robards. It was a real great comedy. They have Keanu Reeves in the drag racing. It didn't end well for him, but that's the image I'm getting right now. A couple more office stories we'll run through very quickly. We kind of spin out, to use a car racing metaphor or phrase. On the positive side, I have two. This first one comes from Nicholas Ritzy of the Commercial Observer. The Empire State Development has relocated its office to 655 3rd Avenue. That's part of Midtown East. They signed a 20-year lease for about 120,000 square feet, 5 full floors of a Durst building at 655 3rd. So anytime you see a lease with 6 digits in it, that makes us very happy. Durst, we'll talk about them a little bit more in a minute, but I got to say, they are the kings of dodging bullets. They had that big building in Times Square that had 2 tenants, Skadden Arps and Condé Nast. Building went completely vacant when those 2 tenants left, and they re-tenanted that thing and came out smelling like a rose. And here in a very soft market, they've gotten the ESD to take on 120,000 square feet. Asking rent there, by the way, $69 a square foot. Another one here, this comes from BizNow Boston. The writer there, Taylor Driscoll. We talked about this maybe 2 or 3 months ago. Tech firm Toast had terminated their lease in Boston for about 130,000 square feet. That was a crabgrass story a couple months ago. Now it turns out that they have moved their operations to a new part of Boston and have signed a 102,000 square foot lease at 33 Summer Street. So while they are giving up considerable space from that other operation or that other office that they had been located, another 6-digit office lease, this time in Boston. So some good news there.
Yeah, I think it's great to see these leases. I think the ESD 20 years in this market, love to see that. And the BizNow Boston story, interesting. I'm assuming maybe they got a better deal in the Fort Point neighborhood, so it made it worthwhile for them to sign a new lease after terminating their larger lease in Boston. So great to see a lease there, and hopefully, the previous building that Toast was occupying is able to get that square footage lease back up as well. So some good stories. I think that's one thing. It seems like every week we find some green shoots, even in the office sector, and these are a couple of them.
So my potpourri, in no particular order, they're not really green or crab. Well, there's one crab and the rest are just kind of just points of interest. This first one comes from The Real Deal. I didn't write down who the author was, and I apologize for that. But Silverstein and Metro Loft closed on a purchase of 55 Broad in Lower Manhattan, and they're going to start an office to resi conversion there. We've talked about this being a possibility for some properties in Manhattan. There had been some press earlier this year that Silverstein was quite interested in pursuing this. They're going to take a crack at converting 55 Broad in Lower Manhattan from the office to resi. I'm not sure if that's apartments or condos. This next one is the crabgrassy one. It comes from Dan Brendel of the Washington Business Journal. J.B.G. Smith announced yesterday that their offices in National Landing, we're going to only see a retention rate of about 33% over the next 2 years. They have 72 tenants that are up for renewal over the next 12 to 24 months. They expect only about a third of them to renew. The parenthetical here is a lot of that is Amazon space, and Amazon was always expected to move out of this. But they went on to say that it's not just Amazon, that other tenants in these buildings on Crystal, and I forget where the other property was located, are giving back space in droves. And in the case of 2100 Crystal, if I get the address right, in the case of that property, they're going to actually mothball it for now. They're going to not try to re-tenant it up at the moment and decide whether this should be repositioned or re-tenanted up down the road. We'll wait and see. The last one in my potpourri, this comes from Miriam Hall of BizNow, an unusual one. Durst, who we talked about a moment ago, is suing its own tenant, Bank of America, to keep them from subleasing some of their space to another tenant at a Bryant Park office in Manhattan. So what you're seeing here is, I think, that in this case, the other tenant is Aiken Gump, a law firm. Bank of America has spare space. Aiken Gump wants to give back some of its space that it's leasing from Durst and take some space from B of A that would come out of Durst's square footage, and Durst is suing them to prevent this from happening. So it's a story we'll follow. You don't see it very often. Usually, as a landlord, you're trying to keep your tenants happy, but in this case, I guess Durst felt they had no choice. So that's the last of several random office stories that caught my attention.
Yes, let me circle back real quick to the REITs. I had a few more bullet points on that since you covered those stories there, Manus. We've seen a kind of a wave, a roller coaster effect on the office REIT sector. So coming out of COVID, a lot of them hit all-time highs in their stock prices. And then now, obviously, they're down significantly. So, a couple that we wrote a story about with our sister company, CRE Direct, SL Green, saw its stock price, it's down 71% from the post-COVID peak through the end of the first quarter. This last quarter, it recovered somewhat, but ended the second quarter 63% lower than the post-COVID peak. And then Cousins Properties, which owns a lot of office properties across the Sun Belt, they also faced a really tough time. Stock price ended the second quarter at about $22.80, which is about 43% lower than post-COVID peak in January of 22. So you're hopeful for these REITs that they're able to maybe reposition these assets or offer some incentives to get the occupancy back up, but their stock prices right now are definitely feeling the effects of the office downturn.
And while you talk about lenders and buyers and property owners and so forth, sometimes REITs are property owners and sometimes they're also borrowers, those that mortgage up their properties. It just reminds me now of something else that I saw this week. But we talked in the very open about capital being constrained, and we talked about banks trying to sell assets. If they're trying to sell assets, right, that's another way of protecting their deposit base. It probably suggests that they're not being as aggressive as they might otherwise be in terms of making loans. We'll get a better picture of that as the coming months play out. But there was a headline this week that said both KKR and Starwood were not making loans anymore, that they had both put, I don't know if it's a hard stop or, it's by appointment only, as some people like to say, if you want to get, some lending done. But it just goes to show CMBS has tapered off a lot in 2023. Lonnie, you referred to that before. Banks not lending. Starwood saying that there is no debt to be had out there as a borrower, and then Starwood and KKR as lenders being reported as not putting money out there. It really leads you to say it's either insurance companies or nothing. I'm not sure if insurance companies are being aggressive right now or not. I haven't spoken to people in that market in a while, but it seems like they have a lot of runway right now, and it could be kind of the only game in town.
Did you know Trepp's trusted data and analytics serve a wide community of structured finance professionals? Trepp CLO is Trepp's newly released corporate CLO product. The solution offers sophisticated tools for corporate CLO portfolio analysis, enabling investors and managers to gain deeper insights into their investments. Users can assess performance metrics, risk profiles, and valuation models to make informed decisions and optimize portfolio strategies. Trepp CLO provides users with reliable data, daily news, enhanced portfolio analysis, and precise valuation capabilities. Email info@trepp.com for a demo of the Trepp CLO platform.
Okay, so let's talk about retail. We saw some store closure announcements this week.
Yeah, so there's a pretty big announcement for those of us in Texas, especially the high schoolers. Alice Formal Wear has decided to close all of its DFW stores. Had 26 stores in Texas and at least 10 were in the Houston area. So pretty big announcement for kind of a local retailer that provides, tuxedos and other formal attire for rent or for purchase. And then there were some other just Twitter chatter this week around other store closing announcements. And so if you look at this list, I think the author was basically showing from their perspective that this was a significant list of closures, but I would take the counter to that and say, a lot of these were things that should have closed or that we've known about for some time, Bye Bye Baby being an example. But on the whole, I think this fits more in the narrative that Manus and I have been talking about for the last couple of months, of where retailers specifically, inline space, smaller restaurants, and even some big boxes have, if you made it through the pandemic to here, you're probably here to stay. And so on the whole, I think, this list of store closures, which was led again by Bye Bye Baby, kind of an outlier. Everything else was in the single digits in this particular market. So I think bodes well for retail on the whole. And I know we don't talk a lot about retail on the pod. We probably should bring up some more retail stories outside of the mall space. But if you're not following that market closely, pretty much across all the major MSAs in the US, occupancies are at all-time highs and rental rates are really, really competitive right now on the retail side. So those that have reinvented themselves with this new omni-channel delivery, right-size their footprint, et cetera, over the last several years are reaping the benefits of that now.
Lonnie, I got to ask that, after you're done posting those pictures of you in the muscle car, you got to post those pictures of you at the prom with that baby blue tux with the big ruffled shirt and that tie that looked like it was the tail of a kite, right? The one that you used to tell me about that, beforehand, you'd take your date to Whataburger and then, you'd be out there, doing the electric slide in that baby blue tux. Put that picture up there.
Yeah, we'll see what I can do on that. I mean, I actually used to drive the muscle car with the baby blue tux to Whataburger, and then I would stop by one of these retailers that just closed down. So nostalgia all over the place.
And we have a healthcare story.
Yes, we do have a healthcare story going back to my copious notes here. This comes from a commercial property executive. I hope I pronounced this correctly. Madalena Hojaga, I hope I pronounced that correctly. She reported that Boyd Watterson Asset Management has purchased the 275,000 square foot outpatient clinic in Austin, the Austin VA clinic, for $142 million. Obviously a big purchase price, but it's another part of the market we don't talk about that has done fairly well in the last 6 months. That while the velocity is still down, it's not down as much as you've seen it in other areas, and that is medical office. This is a clinic. This is more like a hospital than it is a medical office per se. But medical office has been another place to hide in 2023 for people. It's of that category, like we said before, that people need their haircut. People still need their annual physicals. They need to get things checked out, and it has been a nice place to hide, and good on Boyd Watterson for picking up this property.
Yeah, I think this is another great story, and I would agree. The medical office healthcare space has really been resilient. $142 million transaction. The VA operates this property, so nice sale for the seller and great asset for Boyd Watterson to pick up.
We do talk about the negatives a fair amount, but there are places to hide. We talked about small balance loans, medical office. At some point now that we're in that window where if you're driving down a highway, you can't help but see people in their Honda Civics packed to the gills with Foot Lockers and other things going back to campuses, right? With their little sticker on the back saying Wake Forest or North Carolina State. And another place to hide has been that student housing space. We'll have to do a segment on that now that we're back to the return to school window. And I was just thinking about that. My son is going back to Clemson this week, and this will be his third year in the same apartment. Every year pushing up rents, I don't know, 6%, 7%, 8%. I don't know, right? Give till it hurts, I think, is their motto for parents. But, the landlords that haven't had to set foot in this thing, by the time they're done, 36 months, not a coat of paint, not a vacuuming, not a replacement of a rug, nothing. This has been nothing but sheer profit that has grown year after year after year. Talk about a place to hide.
Yeah, student housing is an interesting asset class. And I will say, we thought maybe there was some challenges for them in COVID where they weren't going to be able to survive, but the lease structure where you live there 9 months, pay for 12, really helped bail them out. And to your point now, they've come back with a vengeance and rental rates have been increased across the spectrum. I think the only reprieve is if you're in one of those campus locations where they just overbuilt and so they don't really have pricing power. But outside of a few schools, that's a really, really competitive market right now. So if you're a listener in that space, I'd love to get some insight from you on what you're seeing in the market. But everything we're seeing shows, as Manus described, basically full pricing power on the side of the landlord at this point.
De minimis, at least in the cases I see, kids stay there for 2 or 3 years. You don't have to touch it up. And one of the things I hate, here's another detour. Sorry about this, Haley, to do this to you again. I feel like these colleges, the business model is trying to encourage kids to be on the 5-year plan, right? That course that you need to graduate, that prerequisite, they give just infrequently enough that 25% of the kids can't take it freshman year. They have to take a sophomore year. They can't graduate in 48 months. They have to push out another 6 months, which the kids love. Don't get me wrong. They think this is the greatest thing ever. But I do think it's part of the business model, and it's annoying.
Yeah, listen, I'm close enough to the academic space to know there's definitely strategic initiatives that try to drive enrollment numbers and try to drive tuition and everything else. And a lot of these student housing complexes now have some sort of, at least the public universities have some sort of arrangement with private developers that build, properties on the campus. And so the school gets some residual on that. To your point of being a college student, hey, sorry, Dad, can't graduate, got to stay an extra semester or two. Not the most terrible thing. 7 years down the drain.
And lastly, we had a TreppWire newsflash this week on an industrial deal.
Yes, we've talked about the dearth of CMBS new issuance. It's better than it was. It has picked up in Q2 and thus far in Q3 in terms of issuance. It was really anemic in Q1, picked up in Q2. I think it's going to be okay in Q3, kind of on par with what we saw in Q2. We've seen some slight pickup in the CRE CLO space. I think we saw one deal get done this week, which was a good thing. The deal we referenced in our Trepp flash, this was reported by The Real Deal. They noted that Praylock, which is a buyer and developer of warehouses primarily for Amazon, has refinanced their debt. So they have come out with a new deal for $1 billion, backed by somewhere between 12 and 20 Amazon occupied warehouses across the US. The interesting thing for me was that what they did here was they first securitized these assets in 2022. Their interest rate was high when they started and went higher because of higher index rates, because of a higher SOFR rate. They were able to take out that $550 million 2022 floating rate loan and refinance it into $1 billion fixed rate loan. So for Praylock, what does this do? It lowers their debt service costs. It takes away the uncertainty of future interest rate hikes, higher debt service, and allows them to lock in fixed rate, which I think the article said the handle was going to be in the fives, like a 5 coupon. Don't hold me to that, but I think that's what the article says. So look for that if you're curious, but a little bit of sign of life in the CMBS primary market and nice work by Praylock in reducing their debt service costs.
And let's turn to shout outs. Firstly, we have a shout out from our own Susie S's client, Manny T, who is a big fan of the podcast and listens every week. Jennifer W said she loves the podcast and listens every Friday on the way to the office. That's a good sign that people are going to the office on a Friday. Trevor N said he's a new listener. He can't remember how he found us since he's not exactly our normal audience. He's on the operations side of a heavy civil private sector construction firm. So he said it was very insightful to hear what's happening on the commercial real estate side, to tie back into and get a good indication of where future work in his industry might go.
Trevor, I got to tell you that if you search long enough, many cities are telling us now that people are aggregating in bars to commingle and listen to the podcast together. And they pick a certain word for each podcast. And if Lonnie and I say it enough times, each time you have to throw back about 4 ounces of beer. So, look for that in your local neighborhood. I hear it's a great way to meet people. And
Ben K is a new Trepp hire who loves the podcast. Zara W said it was so great to have CRE discussed in the broader context of the financial markets. She listens to our podcast as part of her Saturday morning routine. Gary N really liked our hamburger wars discussion from last week. We had a few people who liked it. He said he's originally from Honolulu, so the hamburger chain there is, I'll try this, Kua'ana. But he said, why did nobody give a shout out to White Castle? So I don't know. Is that on your guys' list? I don't know if it's on mine.
Be Castle used to be our stopping point after playing beer league hockey. There was one, I think it was off the Bruckner in the Bronx. We'd be back from Harvey Rink up in Katona, New York, and we'd stop there at 1 o'clock in the morning. The funny thing about White Castle is the hamburgers are so small, it's not that hard to down 15 of them. It's really something. They're incredibly greasy, but they are delicious. And I had forgotten about White Castle, but I have to give a hat tip to that White Castle shout out. And I do want to pivot for 1 second to something more serious. We have been watching those forest fires in Hawaii. Late today, we had people asking us about exposure to commercial real estate in Hawaii. We will address that next week. The parenthetical here is that historically, events like this, whether they're floods or hurricanes or wildfires, are covered by insurance, and the impact to commercial real estate has been de minimis. Obviously, a large loss of life in Hawaii. I think it was up to about 40 people earlier today. We're rooting for the Hawaiians right now that people get this under control. Our thoughts are with them. And for those that are worried about real estate exposure, we will address that in the future.
Yeah, that's one of the most beautiful places that I've been to. I mean, it's just really magnificent. The images coming out of there are just really horrific. So I'm hopeful that the insurance will provide people to build back and build back better, and just really scary stuff. So thanks for mentioning that this week, Manus, and we'll definitely follow up with some insight on the data side next week.
Yes, we actually had a listener and client reach out to us through Susie S, Pramod B, and they said that they were looking forward to us covering this topic and sharing some of the exposure data. So more to come on that, and we'll be sure to respond to your email as well. And a few more shout outs. Matt W said the show has been great recently. Cami B, Bob P said he has to tell you, Lonnie, he has found nothing special about the Whataburger burger. So he said Carl's Jr. is the winner. I know you gave him some recommendations to make his next trip there a little bit better. Trevor N is a new listener. He sent us his first email ever and then said after hearing our hamburger wars discussion, he was inclined to send another. So he's a self-proclaimed In-N-Out aficionado, and he gave us some feedback there. Matt E thanked us for the podcast. Jonathan B said he loves the podcast. Kyle K said this is the best podcast related to CRE. He said he hasn't missed an episode in the last 3 years. And he said his perfect combination is Thirsty Thursdays and the TreppWire Podcast. So there we go. A few others, we had reach outs from Scott A, Molly C, Ryan A, Jason S, Max H, Richard W, Pete V, Daniel M, Frank S, John P, Carl M, Faris S, and Brandy B.
And I'll give one more. Joel down in GA sent me an email and gave you very high marks, Haley, for your smooth transition into the host seat and says you're doing a great job keeping Lonnie and I honest and moving along.
You had some other positive feedback this week too, Haley. There's a lot of Twitter followers that have picked up on your contributions. And as I've said on the Twitter and say here, Haley does a lot of stuff behind the scenes that nobody sees, but the podcast wouldn't be what it was without her doing the production work that she does every single week without asking for anything. So definition of team player for sure.
Thank you, guys. We make a great team. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.